So my mom recently started investing in the stock markets, and she made her first bulk investment last month into the stock market when the Nifty 50 was down by roughly 15-16%. And then within a month, she made a profit of 5 to 6% because the Nifty rebounded. She was very happy. Then she started reading the news that, that US is going to have recession and investors are going to lose crazy wealth. And she was a little bit sad that, if this happens, then whatever portfolio she has made, it will just go to dust. I told her that recession is probably the best time to build more positions, and if the market falls more, she should add more stocks. The reason is very simple, that it's almost sure shot guaranteed that you will make money in a recession if you invest sensibly. So on this video, I'm going to help you understand that what recession truly means for investors, why you should build more positions, and I will show you data, charts, graphs from previous 2 recessions as to how market exactly behaved, what you can learn from it to deal with the current recessionary concerns. But very quick note, take a look at this. This indicates the possibility of a recession in the US. Now the possibility of a recession is fairly high. Some analysts are saying and giving it a 50% probability that a recession will be there in the US. When you read such headlines, you will start panicking that, I'll just stop buying stocks, or I would not buy anything in the market, sell whatever portfolio I have. On the flip side, when you start noticing things like Google falling by 22-23% from its peak, Nvidia correcting, good stocks like Microsoft, Amazon correcting, you will start creating mass hysteria, mass panic. So let me now systematically help you understand the logic behind recession, what it exactly means. So first key point that you need to know about recession is the meaning of recession. It's a little bit technical, theoretical, but I'll explain it by using very simple example. Now, economists tells us that the meaning of recession is 2 quarters of economic slowdown. Now, what is the meaning of economic slowdown? This is what people confuse. People think that economic slowdown means that GDP was 100 units, okay? And then GDP went to 90 units. So this is called as degrowth, okay? This is very different from recession. Recession means that if GDP was growing at, let's say, 100 units, right? And this is year 2025 and 2026, it went to 110 units. So what is the growth rate here? It's 10%. Now after that, it only went to 120 units. Now here the growth rate is what, like 9% or something, right? So if this keeps on happening, that the GDP growth rate slows down, this is what the meaning of recession is. And people confuse it with negative growth rate. So please understand this technical viewpoint first, because what people end up thinking is that, oh, recession is coming, everything will be destroyed, nothing will be left. And there is mass hysteria, mass negative sentiments around it. Right now, if you study the US market, now again, this is applicable to India market also, because whenever there is a recession in the US market and the India market are correlated. So even the India market is likely to go down because of recessionary concerns. So let us quickly see what is happening in the US market. This is QQQ, which is Nasdaq Composite, right? So here you would see that the market has already fallen 14% from its peak. If you study the weekly candles, right? So here every candle I'm indicating on a week wise basis. You can see it from here and you'll see 1, 2, 3, 4, 5, 6, almost 6 weeks consecutively the market has been falling. Okay, so this is not good news. This indicates that something bad could happen, right? So this is point 1 that you should know, that the market is going down. Now a lot of recessionary concerns are coming into the market. People are thinking that now we will hit recession and this stock market is going to fall like this. So now please watch this video carefully from this point. I'm going to help you understand the data around recession, what it means, how you can track it better, how you can better your investment. Please watch this video till the very end. If you don't have the time, don't watch it now. Please don't watch this video only. That will be better. But if you just gain half the info and just act on it, it will not be useful. Okay. So let's start and let me show you 2 data points first, right? The first key point is that let's study the last 2 recessions. And the last 2 recessions in the US happened in the year 2020, which was the COVID recession, so to say. And before that, it was the 2008 recession. There were concerns in 2022 that there would be a recession, but the stock market fell even without going into a recession. So this 35-36% correction that you see on Nasdaq QQQ, right? So this was not a recession. Okay. This stock market fall happened without a recession. This was a recession. This was 2020 recession. Similarly, in 2008, that was another recession. Important point to note here is that, see, GDP shrinking by 2 quarters, which is the technical meaning of recession, it might or might not correlate with a stock market fall. Okay, simplest example to pick here is that this is 2020 COVID fall. Okay, this was a recession and this was a valuation correction, which was not because of recession. This was simply a valuation correction. Why did the valuation correction take place? Well, if you just apply a little bit of brain here, what you will see is that the before COVID, so I'm showing you before COVID picture. Before COVID, 2019, 2020, up until 2021. So almost 2 years, right? The market went up by 72%. Now this is approximately like 35% CAGR. Okay. Now this is crazy, right? So therefore the valuations corrected here. Important point again to notice that stock markets can fall even without a recession. This is a point that many people miss. But now let's study that what happens if recession is there. Now, how much can the stock market correct by? So for this, let's look at the last 2 recessions that have hit the US stock market and subsequently the world. So what has happened there, right? And here, let me help you understand the broad market in the US, which is S&P 500 and NASDAQ both. Okay. So this was a special recession, so to say. Now, why special? I'll explain it in a minute. And the total market corrected here, and this is NASDAQ, right? So NASDAQ corrected by roughly 28%. Now this does not look like very scary, right? Because the reason here is that in 2020 COVID, all people were sitting at homes and they were using more of tech, right? From Netflix, right from Amazon, right from consuming content online, etc. So this actually benefited tech firms, right? And NASDAQ is basically a tech index or primarily a tech index. So what happened on S&P 500, which is a broad market US index. So this is like Nifty 50 of the US. Okay. So what happened here? Now here, if you study, now this was the fall. So here the markets fell by roughly 36%. So here the fall was a little bit deeper, right? Because the tech stocks, which are NASDAQ, they corrected less compared to S&P 500, which was a broader index. But we can pretty much conclude that the total market fall on due to this recession was how much? It was 36%. Now what happened after that was beautiful, right? There was a market rally, and how much was the market rally? If we consider it from the bottom, there was a market rally of 122% on the broad index. This is huge, right? And this came in how much? This came in how much time? From April to November, December. So this was roughly like 1.5 years. And if you consider it from a pre-COVID basis, right? From the top to top, even if you analyze this, this is still a 20% CAGR. So here you can see total returns at roughly around 42%. So divided by 2 years, it's roughly like 21% CAGR. Okay. Point I'm trying to tell you, and again, I'll erase this before I give you that key takeaway, that recession is a great time to be buying stock. Why am I saying it? Because if you study this part, right? So let's assume that you would have invested money at any of these falls here. What would have happened? Well, you would have made a lot of money on these investments. For example, if you would have invested, let's say 1 lakh here, 1 lakh here, 1 lakh here, then this third 1 lakh, this would have grown more because you bought the index at a lower valuation. Therefore, I'm saying that recession is a great time to be making money. Now, if we fast forward this to 2025, what is happening in the US market? Well, the broad index has fallen by roughly 10%. So if you do not have much positions in the US market, and if you start building positions now, and this entire thing, right, this entire thing here turns into a full-blown recession, right? And if you keep buying this curve, you are going to make very healthy money. Okay, so that's commonsensical. This we have seen in 2020, where there was a V-shaped recovery, right? So V-shaped recovery, let me quickly show you what is the meaning of V-shaped recovery. So this looks like a V, right? So this is a V-shaped recovery. In 2008, because some of you would say that, okay, you have picked an exceptional case of 2020 recession. What about like the recession before that? What happened there? So let's go to 2008, which was again a recession. So what happened there? Let's quickly study. So this was a recession. So this started in the broad market in July of 2007, and the markets fell by how much? Well, the markets fell by 58%. Now this looks more serious. This was a W-shaped recovery. So you can see that this looks like a W, right? And the recovery happened in this manner. So this was a W-shaped recovery. So let me just zoom out. So this point becomes much clearer. So this is a W-shaped recovery, right? 2020, we had a V-shaped recovery. 2008, we had a W-shaped recovery. Now comes a very good question, that if a recession is coming and if I buy it here, I keep on downward averaging it, then of course I'm going to make money. But What is the problem? What is a practical problem that we face? Well, we don't know how to construct a portfolio. We either enter too early. For example, right now you are seeing a 10% dip on NASDAQ. You'll get super excited that let me buy everything. Or let me buy like some weird things in the market right now. Tesla I'll buy or whatever, right? So you might make an entry level mistake. So your point of entry is really bad. The second mistake that you make is that you don't know how to downward average or buy the dip correctly. That's a second key problem. And number three is that you don't know how to rotate capital. For example, if you study this particular dip, 2008 dip, right? So here you will see that there were ranges. For example, this range, right? So this was an upward trend, right? This was an upward trend. This was an upward trend. And this was a downward trend. This was a downward trend. So even during this phase, because most of you would think that, okay, I entered with like 10 lakh rupee here and I kept that money till here and it remained 10 lakh. So in a almost from 2007, so this is 2007, all the way till 2014, how much returns did I make? The answer is 0%. No, but the markets do not function that way. Markets give you an opportunity to rotate capital. I have been insisting this on my channel that the next layer of smart investors would be who learn how to rotate capital. In case you guys are interested, I do run a US stock specific community where I do regular classes, do deep dive on my portfolio, give you every day quick commentary on whatever I'm buying and selling. So in case you are interested, you can definitely check out the details. I'll put it up in description and comment box. So you will learn things fundamentally. So anyways, coming to the topic that see, if you are buying stocks poorly in a recession, for example, you just buy it here, all your money, 10 lakh, and you do nothing here, nothing here, nothing here, nothing here, and you're just not participating in this entire rally, you will pretty much be out of the stock market because close to 7 years, you made like 0% returns. And why was this the case? Because number one, your point of entry was really bad. You bought the market at the top. So what is happening right now? Well, number one point is that if you have not purchased much of the US stocks, this is a great point of entry. Why? Because you are getting the market 10% cheap to begin with. This should be your first major bulk buy, right, at this level. What you should buy, which specific stock should you buy? Google, because if I show you Google right now, right? So take a look at this. So this is the chart for Alphabet, which is the parent company of Google. And here you will see what? You'll see a parabolic drop, right? So this is dropped by like 28-30%. Should you buy this? Okay, I'll not reveal the answer, right? I'll write a detailed note tomorrow on Google, whether I'm adding more positions, how I'm doing it, etc., etc. So the first key mistake that people make in terms of buying in a recession is that their point of entry is horrible. Okay, so this mistake, if you can avoid, this is already getting avoided. If you have just started to invest in the US market, great time to start investing and building your portfolio for a recession, and then you hope that a recession hits. Okay. Why? I'll explain that. Okay. Number 2 point is called as position sizing, right? Position sizing. It means that how you are building your portfolio on a company like Google. At what installments will you buy? Will you buy at like 5% dip, 10% dip, 15% dip? If it corrects too much, then how would you react to it? If you have to sell off that investment, because it might happen like, that Google's business model goes haywire and you have to book a loss. So this comes with a little bit of experience. This is where you need a little bit of hand holding. But people who go through this phase really well and are able to do this part really well, they are the ones who benefit from a recession. So this is third. The third key point is capital rotation, right? Capital rotation. Now, the prime example that I can give you is that of Apple. Okay, so Apple, I'll just quickly show you. Now here, what you will see is that, so this was a phase where Mr. Warren Buffett started selling Apple, right? And Apple corrected by roughly 20%. But since then, it has bounced back, right? When Mr. Warren Buffett sold, even I got scared. I sold my positions on Apple. I thought that, Apple is fairly going to do poorly from this point. And I sold my positions early, right? And was that a smart move? Probably no, right? I should have retained it. Now, God has given me another opportunity that Apple is down like another 16-17%. Will I be buying it? Maybe, but I will build my positions very intelligently here. I am almost 30% done in terms of building my US portfolio. 70% I am on cash right now. Okay. This I will deploy strategically. Why? Because if this is really recession, right? And if it hits, I don't know till what point it will fall, but it will fall, right? And if a recession hits, I'll be kind of happy, at least from a stock investing point of view, that I will get more items at a discount. Because real money is made when you actually invest money in a recession. Now comes the next point, that how would you track whether a recession is really happening or not? So for that, you can go and study a data, right? This data comes from the Conference Board US Economic Outlook, right? And I will put the link in the description and comment. You can study it. And here are the estimates that they have run. So for example, real GDP will contract. Is this contracting? So in 2024, third quarter, it was 3.1 in the US, 2.3. Now it is contracting. And the chances are that in the year 2025, 2026, there will be GDP slowdown. Now, will that turn into a full-blown recession? It remains to be seen. Maybe, maybe not, but it is very likely just by mirroring this data, we will either go sideways or there will be a recession. Okay. So this is likely to happen. Again, a great time to start building your portfolio in the US. That's all I can say. Real money in the next 3 to 5 years will come from here. Okay. This is one. Second is that there are indicators of recession. The first key indicator is the contraction of GDP. This is happening. Yes, this is happening. Second key indicator is consumer spending. So consumer spending means that, let's say last year you were spending 5 lakh rupees in the economy. Now you are slowing down, investing only 4 lakhs. So is consumer slowdown in spending happening? Again, you can check the data. This used to be 3.7, 4.2. Again, there has been a slowdown in the growth rate. So next 2 years till like 2026, right? The market again look kind of sideways from this. Okay. Government spending. So total government spending, again, massive slowdown, right? Even in India, the government spending is hardly kicking in. Again, you can see this from here. Again, there has been a massive slowdown in government spending. So all these factors indicate that we are likely to go sideways or down. Finally, is the unemployment rate. Now in the US, the unemployment rate kind of stays stable, right? Honestly, like this data hasn't changed, right? Whenever there is a massive change in this data, we can pretty much conclude that a recession is about to hit. It will start reflecting into the stock market. Now, again, I will highlight this particular picture here, which talks about the probability of a recession. Short answer, it looks like that there is a 20 to 50% chance that there will be a recession this year, right? In 2025, it will slide over to 2026. Will these stocks correct? The short answer looks like a yes. The stock market in the US is already factoring that in. Third key point, will you lose money if you invest now? Well, if you have 3-year perspective, then I can say it with certainty that if you're smart in terms of your investing right now in the US stocks, you're unlikely to lose money, right? US is a very strong economy. Stock markets will rebound. The only sensible decision that you need to make, again, recapping what I had taught earlier, that number one, your point of entry should be really good. Number two, you must learn how to downward average it. Number three, from time to time, even within this recession, there will be opportunities to profit book. There will be capital rotation opportunities. You must take that. If you're doing these three things, it will make sense. For you to execute this, you need to come up with some kind of strategy. Now, of course, I'll be teaching all these strategies on my course, on my community, etc. But if you cannot afford to do that, that's also completely fine. I'll at least tell you one strategy, that please keep 4 buckets of money that you would be putting into the market. Okay. So for example, if you want to invest 10 lakhs right on NASDAQ, just start with 2.5 lakhs to 3 lakhs right now. And if the market falls by 5%, then bring like another layer, right? If it falls by another 5%, then bring another layer. Then if it falls by another 5%, then bring another layer. Then you'll say that, okay, what if corrects by more than like, another 15-20%. I start investing here at 100 when the market is at 100 and it falls to like whatever 85. Okay, so what happens after that? I've run out of money. Do nothing. Sit tight. Wait for a rebound. Okay, because then your point of entry becomes really good, and after that it's slightly more advanced strategies. But I hope that you enjoyed this video. There is nothing to be scared of when it comes to recession. Don't believe in nonsense news. As long as you are not trembling, as long as you are a sensible investor, you will continue to make money. Thank you so much for watching, and I'll see you soon.